Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our Frac Spread show. I unfortunately was very sick on Wednesday and was not able to film. I don't know, it's something that's been going around. I'm sure you have friends that are either sick, and no, it was not COVID. I know that was probably going to be a question, but so here we're just going to try to keep it a little brief. We're going to look at what happened in the US, what happened with OPEC, and then what are some of the shifts that we're seeing in Russia, and then just a touch on the econ, but then we'll do obviously a deeper dive next week. So when we look at spreads, we had a strong start to May, coming in with an increase of 5. So we went from 273 to 278. And the lion's share of that was really driven by the Anadarko, the Appalachia, and some of the smaller basins. But as we've been talking about, we do see some additional equipment moving into the Haynesville and moving into the Eagle Ford. So we do see some of these additional shifts. We expect to see the Permian getting back to the highs of about 157 over the next few weeks. And again, that's that move back to 290 that we expect to happen over the course of May. And then it's the question is going to be, how close are we getting to 300 as we move in from May into June, as we've had rigs that have continued to come back, and the spread between rigs and spreads continue to remain fairly wide. And for those that get our insights, I have a chart on that in your inbox. So now when we flip to rigs, you can see that rigs were up again. The U.S. was up by 7, 5 oil, 2 gas, and a total of 4 directional and 3 horizontal, with a larger part of that still targeting New Mexico, Louisiana. So again, we're still seeing that focus on the Permian, the Eagle Ford, and then again, when we look into the Haynesville, we're still seeing that on the in Louisiana on the Haynesville side. So again, there's still a lot of activity happening. And one of the big things that we've been talking about is that rigs were going to continue to run up just as you get that dip that we normally get going into the into spring break, Easter, that we're now coming out of, because again, these are some of the key pieces of making sure there's enough ducks and running room to get us through that big push that normally happens during the summer months, which is where we usually see our peak activity. Now, another fun thing that has been happening is, well, let's look at performance on the commodity side. And here, I think it's important to see that energy, as natural gas has taken the center stage, going up 21%. For those that have the insights, I have a seasonal chart. We took out the 2007 highs. Only 2008 was higher. And remember, 2007, 2008, we didn't have the shale revolution. So just think about where natural gas is and how it remains elevated. And then everything else are a lot of, well, I shouldn't say not just everything else, because all of those top pieces really account for a large part of inflation, and not just in the U.S. When you look at natural gas, wheat, gasoline, cattle, crude, different products. Again, these are all the things that we see as a continued backdrop of that push higher on the inflation front, with little to really change that mantra. Now, one of the things is at yesterday's OPEC meeting, they stuck to the previously announced plan. They're going to increase by 432,000 barrels a day in June. But again, those are some of the key pieces when we look at their increase, because there's really over well below, or they should say they're over sticking to or just reducing what they should be producing, especially in West Africa. So, there's over 100% compliance with where they are, and so actually closer to almost 200%. But the issue is there's no demand for that oil. And you would think that where the curve is, you would have, the physical market should be clearing. But the problem is the types of oil, and that's where we're seeing some of this disconnect in terms of, why is nobody buying it if there's such high demand? And then it comes down to, what is the crude quality, what is the crude availability? And that's when we start looking at Russia. So here's looking at Russia seaborne crude flows. Here you can see that there's been an underlying shift. Obviously, a lot of that has been trying to move to the Baltic to try to get out into the market. Total seaborne crude has dropped, even though when you look at what is being slated, They're at about 4.5 million barrels a day. Now, India is out there essentially saying that they want cheaper oil and they want it to be 70% below dated Brent. And when you look at the fact that India has been picking up about, almost 70% of their oil, they become kind of the price setter of like, this is what we want. And if you don't get it, well, we're going to go somewhere else. But then at the same time, Russia's like, well, where else are you going to get this kind of discount? So it's going to go back and forth. China's been playing the game back and forth. They've been reducing some of their sales, and they've actually increased the export of their light sulfur fuel oil. They had cut it in January, and because of the lockdowns, they've actually started to shift that back up. But this is some of the key pieces. And this is also, again, leveled on where the EU is in that ban. So they're talking about banning Russian crude by the end of the year. They're talking about giving some allotments to several EU nations that would expire in 2023, and then one in 2024 to give other countries more time to adjust. So again, that they talk tough, but then when they look at actually trying to implement it, they're getting an idea of just how painful that's going to be and what that would look like in terms of trying to replace. Now, it's something that's going to be gradual, but you're getting an idea of where that shift is. So even though we're getting those different components, you have to look at where are sanctions and how is that going to hit Russia's budget. So they're obviously still making money. Crude prices are elevated, as we all know, but they're still trading at a steep discount to dated Brent. So then you have to look at, okay, well, what happens? And I thought that Bloomberg Economics put together a very good kind of scale in terms of what happens if the EU gas flow ends, what happens if no energy disruption. So it's going to be somewhere in the middle, and that's where you start to see where those issues are going to come in terms of the revenue side and the percent of GDP. Now, that's as that pivot away from going into Western Europe goes into other areas. Again, the discounts will have to rise because there's going to be an insurance issue. Can you get the boats? What is the boat going to cost? What's the time to get there in terms of day rates? So again, these are things that are going to have to be looked at. And because there is so much Russian crude that is fairly cheap, that's why we continue to see West Africa with this elevated floating storage. Angola still has several cargoes waiting to load in May, which is very rare for the loading month. They were able to sell some of them at a steeper discount than what was initially posted, anywhere between minus 80 cents to dated Brent to minus $1.10. And again, that's just because if you have the option, well, this doesn't yield a huge amount of distillate. It does yield distillate, but again, they're trying to focus on and reduce as much as they can, reduce the amount of gasoline that's being produced and focusing on that middle distillate cut, that diesel capacity. So again, that's leaving a lot of West African crude in the water. But this is also leading back to the OPEC agreement, because OPEC is sitting there and saying, all right, well, there's more than enough available in terms of what's in the water right now. And a lot of these different countries have a lot of room to raise production and still being below their allotted amount. So that's why when you look at some of these different disconnects, you can look at the OPEC meeting and say, well, why would they increase it much more when there's all this floating crude and there's countries that have room to increase their cap without breaching it? So again, these are some of those pitfalls. And it's not to say that there aren't shortages of certain types of crude, because there are. It's just when you look at it, it's very specific by grade and not so much by just location. Now, the Middle East still has, they're seeing their floating storage remain fairly stable. A lot of this is caused by the fact that their OSPs are so elevated. And again, as they look at this, they're like, well, why are we increasing oil when we have more than enough sitting in floating storage? But when you look at the spread, nobody is in any hurry to pick up extra cargoes just due to the OSP, which is why when we look at it, you can see it's bounced from below $5 to about $9 between dated Brent and Dubai. And once you factor everything in, it's starting to get close to that point, because a lot of the OSPs are about $9.35, $9.50 above Dubai. So once you factor in where is it going, what kind of grade is it, what is the insurance, what is the sailing time, then you can see it's like, okay, well, is it breaking even? Is it getting close? So that's when we're starting to look at how are things moving and how quickly are they moving. Now, when we look at the product front, you could see that Singapore had another big, a sizable increase, but it's important to appreciate it's all on the light distillate side, and that's what we were talking about. Obviously, not in this past EIA show, but the week before and prior to that, where light distillate's going to continue to build. When you make a barrel of diesel, you inherently make 2 barrels of gasoline, and gasoline demand just isn't really where it needs to be. So you're still seeing middle distillate demand remain strong, and it's very difficult to source the crude that is very high in a distillate cut, which is why we continue to see these drawdowns on this middle distillate with resid and heavy disty moving and staying fairly normal. And the question is going to be, when is middle distillate and essentially countries yielding and saying, you know what, I can't handle this cost. We're going to have to go heavy, high sulfur. And we're starting to get pretty close to that. Gasoline in Europe still remains at a record high, which is why we're starting to see that big increase in exports from Europe into the U.S., specifically PADD 1 on the gasoline front. That's going to continue, just given PADD 1 is net short. Europe is very long gasoline, and that's not something that's going to change. Gas oil increased in Europe, and a lot of that is due to a big increase in imports from Asia and the Middle East on the gas oil front, which is going to continue just because they still remain at a very low front. Now, some of the bigger issues when we start looking out at the world and how China's kind of shifting that, supply constraints are starting to increase in the U.S. These are things that we talked about over the last couple of weeks, where you saw this dip, you saw inventories getting better, and now you're seeing them get worse again. And a lot of that is driven by China. And the reason why we talk about that is because there's refinery utilization rates are still at record lows in China. They're building up a lot of their storage, and there's about 4 cargoes that Unipec is trying to sell anywhere that they can, because again, there's just no place to put it, and they don't need it. So that's where you're starting to get some of this resale, and we expect that to increase. We expect some of the sales of refined products to also increase. Now, when you start looking at what's happening within China, here you can see that road freight still remains low, but starting to bounce a bit. But it's not getting much better. And there's been some new news where Xi has essentially put out a warning that nobody's allowed to question the party when you're looking at these zero COVID policies and lockdowns, which again is going to, because then there was the other side of it where they were trying to remove some of the roadblocks, help people move through. So that's when you get that bounce. But at the same time, you still can't let it spread. So there's starting kind of this back and forth in terms of what's going to happen. But we don't see too much of an improvement in terms of where things are. And this is what you can see here in terms of the COVID lockdowns and what it's worsened. So 1/5 of the world's container ship fleet is estimated to be stuck in port congestion, not just in China, but in total. But you get an idea of just how much of it is actually stuck in China. And I just think this picture is very fascinating in terms of just how much is actually stuck there and why we're seeing some of these supplier delivery times get much worse. And when you look at the satellite data, you can see that port activity is as low, and it's actually just is below where it was in 2020 lockdowns. And the reason why, and we talked about this earlier, the lockdowns in 2020 were really not on the coast. Obviously there were lockdowns on the coast as well, but not as much as the within China. So they were able to avoid that. Now this is something that is hitting, head on what is happening on the coast, and that's some of the reasons why we're seeing some of these bigger slowdowns, which again is just going to show up in the U.S. and really cause a bigger slowdown in diesel demand as we get some of this lull, as we don't have these cargoes showing up at our shore. Now, when we look at the Composite PMI, and we'll talk more about this next week, there was a huge drop off in Chinese PMI, which is what really brought that down. So I thought JP Morgan and S&P Global did a good job of showing, well, what was it without China? And you could see that things are fairly stable. There's a lot of strength still in the ASEAN nations, and that's continuing. Some of that is being driven by some inflationary pressures when we look at prices paid, prices received, delivery times, a lot of the things that we've talked about. But then when you factor in China, you can see that there's been a sizable drop because things are anywhere between the mid 40s, which is contraction, as well as going much lower in terms of mid 30s, even on the services side. But again, we'll talk about that more. Some of the things when we look at the U.S. in general, so when you look at compensation per hour, it's at about 6.5%, and then personal consumption expenditures at 6.6%, and the problem is things are going up. So when you look at the productivity report, but inflation is running at its fastest rate since the early 1980s, and this chart is something that we look at when we're discussing wage inflation. Because when you start, it's not wage inflation, but the wage spiral. Because when you listen to Powell, he's like, there's no fear of a wage spiral. But then when you look at how things are lining up in comparison to the 70s, we're getting into a very close similarity. And the only way we broke that was when Volcker raised rates from about 11.2% to about 20%. And it was just because it feeds on itself because, okay, well, wages have to go up because your living expenses are going up. So you increase wages, but then you increased wages. So you have to recoup some of that cost. So you raise your prices, which raise living costs. So then the living costs go up again. So then you have to raise wages, and you get into this really bad feedback loop, which is creating some of these problems that we continue to see really starting to accelerate as inflation is getting another push from behind. When you look at wage, employment costs going up again, obviously you look at diesel. I think we have a chart on that in this, but if not, then diesel's over $5.50 and rising, as well as other places, which again is just putting in more pressure. Now, when you look at global monetary stimulus, again, you have the stimulus coming out. So you have this big push on the supply chain issue again, but you're still getting this tightness, which again is driving up rates. And some of the things that we're going to look at from here on out are pressure on the U.S. consumer, and pressure on the emerging markets. So when you look at where the policy is, you're getting a lot of this tightness. You're getting a lot of a lot of tailwinds for rates with the Indian central bank raised rates more than it wasn't expected, and they still raised it. And you're starting to see that happen around with the UK raising rates, the Bank of England, and then guiding towards a potential recession and stagflation. So then when you start looking within the U.S., I thought this was a really interesting chart because it shows that even things that have seen their demand fall are still seeing prices go up. And that's all driven by the supply chain. And that's some of the things that we've been talking about because the diesel, logistics, labor, all of that is a pass-through. So even though some of the things should be coming down because there isn't the demand side, you still have that supply side push. So no matter where you are, every corner of the economy or how the PCE looks at it is seeing that price inflation and that price push. Which again, when you start looking at the mortgage, the 30-year, year-over-year change, this is the fastest the mortgage rates have gone up since about 1981, to give you an idea of just how fast mortgage rates have gone, where they're now well over almost 5.3% and rising because the 10 years driving above 3%, which again is going to hurt even further what the affordability is in the U.S. And then again, how can they spend and what does that mean for the underlying supply chain? And some of the things that we've been talking about for some time is the personal savings continues to drop. And as personal savings drops, you're seeing consumer credit go back up. Because I've drained my savings back down, I want to leave a little extra in there, but I've paid off my credit based on where I was in COVID, so I still have a lot of capacity. So you're seeing a lot of revolving consumer credit come up. You've seen it in credit cards, and you're seeing it again here because it's like, okay, well, rates are, my cost of living is there and my savings has already gone down, but I still want to maintain my lifestyle. And the question is, when do people stop trying to maintain it? And it's usually when credit gets back to where it was. And based on how fast it's going, we'll be there fairly quickly, especially given where real wages are and what the annual change is. So when you look at discretionary spending, you can see that across all of the developed world, you're getting this big drop in terms of real wages. And then when you look at that percent change, again, on the real wage side, that's factoring in inflation, you're actually fairly negative and falling faster, with the US negative 2%, Canada almost negative 4%, UK Euro area over 4%. So you're seeing that buying power come out. They're trying to, some of it's being replaced by savings for now. Some of it's being replaced by credit. But again, you're getting to the end of the line, which is where we see the biggest slowdown, because about 71% of GDP in the US is generated by the consumer. But a lot of these nations are developed nations that are import goods. And as they start to slow down their importing goods, it's going to impact emerging markets even more. So then you look at the emerging market leverage, and it's exploding higher. Why? The dollars, the DXY, or the dollar, is over 103. You have global trade slowing. You have U.S. consumption slowing, largest buyer in the world. Other developed markets slowing. You have China not consuming as much. All of that is just limiting the amount of natural dollars that flow into a lot of these emerging market countries. But a lot of them are also still running deficits. So as they're running deficits, as we showed earlier with the rates going up, as they have to cover that deficit, what do? You borrow more. So you're rolling current debt and issuing new debt at exponentially higher rates when you think about rate of change. Obviously, they're still low historically speaking, but rate of change side, so your interest expense is ratcheting up just at the same time that the dollar is also going higher with, and so you then have to go in and you have to protect your currency because there's inflation fears at a lot of these markets. So if there's an inflation fear, you have to liquidate your foreign reserves to buy your local currency to try to maintain a peg, to try to maintain a balance, but then you have to go replenish those foreign reserves because you're not naturally taking them in through trade with a positive trade balance. So then you go out in the market, you have to buy dollars at elevated prices. Again, keep creating this negative feedback loop, very similar. But again, this is why we see a lot of problems within the emerging market world. So, but then as they see problems, they cut subsidies, which then cuts crude demand. And then if they start cutting food subsidies, then that's when you start to see riots increasing and other problems starting to grow. So that's what we have for you today. Hopefully you have a great weekend and you can stay healthy, and I'll try to continue to recover, and we'll catch everyone up next week with our normally scheduled shows. And again, thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.